Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview of the market's key events, both fundamental and technical. And we look at all the trading opportunities that we see around all the key market events and FX majors. Just to bring you up to speed on how we approach this webinar, we think markets are generally driven by themes, narratives and stories which buyers and sellers relate to in order to enter and exit markets. These can be long-term fundamentals, short-term technicals, or short-term narratives, or long-term narratives, and these rise up in importance up and down over time. Of course, risk events will move the needle of these stories, and that is why we concentrate on the key calendar events. We review last week's events and then look forward, obviously, to the key events in the next few days. Technical analysis we really like, and that really allows us to fine-tune, if you like, our trading and entry and exit in the markets. So we always focus on that after reviewing the fundamentals around the key events. This week, we will, as usual, we'll check out where markets are currently. We'll look at some of the key themes we think are driving markets at the moment. And then we'll just do a quick review, having looked at stocks, actually, some of the major stock indices that we always do, and the technicals. We'll then just review some of the important inflation data from last week out of the Eurozone, out of the US. And then we'll go into this week. There's been quite a lot of market moving data, actually, quite important, including the ISM surveys. We get the services today, and we review that, or preview that even, and review the manufacturing data we saw on Monday. That really jolted the markets, as well as the JOLTS job vacancies data, which came out of the US as well, really highlighting the fact that policymakers are very much data dependent at the moment. So that is why we focus on some of the minutiae, if you like, in some of the data, just trying to point out what sort of banks are looking at, what we're looking at, and then what hopefully or eventually will move markets. We'll check out, of course, and review in detail the non-farm payroll data, which is due on Friday. Obviously, that's the monthly US jobs report. And then, as I said, we'll look at some of the data already been gone this week, that manufacturing ISM, as well as then looking at the DXY, so that's the dollar index. And then also those two central bank meetings we've just had out of Southeast Asia, Oceania, if you like. Obviously the RBA in Australia, and then the RBNZ overnight surprising with a 50 basis point hike, as opposed to a 25, which was pretty much nailed on. So surprise there. We'll just run into some of that as well. Look at those majors, Aussie against the dollar, Kiwi against the dollar. And then if we have time, hopefully, if you guys want, we'll check out gold, because obviously that's surged through the key 2000 psychological level, struggled for a time against that level this year, actually, really, but a big move this week. And really then gold bugs seeming to look at the record highs sort of around 2070 and above. Of course, please do ask any questions along the way, however big, however small. We really try to break down all the sort of complexities and jargon that you guys look at, you read about, and hopefully with some of the experience we have here, we can answer those, and also any setups as well that you see, trade setups, and you want just a viewpoint on those, then please do ask in the chat function, and we'll try and answer those as we go along, or at least at the end of the session. I should have just showed you the risk disclaimers that you can just briefly look at here. And just whilst you look at those briefly, as I say, just markets this week, really interesting where we are currently. We did have that surprise oil production cut announced by OPEC Plus at the start of the week. That kind of raised inflation fears, actually, and by extension sort of reduced Fed easing bets. And ultimately they did offer some support at the start of the week, but that really has faded, and it's really important, we think, that those concerns around inflation, oil prices rising, have been kind of trumped by, if you like, growth concerns and the data that we've had this week, especially out of the US. Growth concerns are now more important to the market than anything else. It's this risk of a hard landing after the banking crisis, which seems to have calmed down somewhat. We notice that FX volatility gauges, bond market volatility gauges, they've all eased back now, which means markets are pretty much moving on to the growth concerns. And we can't stress enough, even though we've possibly moved away from those banking issues, the turmoil that we had fleetingly, if you like, in such a major, some of the major issues there. 16th biggest bank, if you remember, SVB, Silicon Valley Bank in the US, that folded. Signature Bank as well went under, and then we had that shotgun marriage, I think the FT called it, between Credit Suisse, long-time rivals, long-time banks, similar investment banks, globally, systemically important banks. There are 30 of these GSIBs, and Credit Suisse was one of them, and yet over a weekend it got essentially rescued. A deal was done with its big-time rival UBS to merge, and kind of what a shock that was in some ways. And I think we've gone through that in previous webinars, at least 2 weeks ago anyway, just about those moves in the fixed income bond markets that we saw. But that's all kind of calmed down. But even though it has calmed down, I think it's important to stress that the effects, especially in the US, with tighter credit conditions, tighter financial conditions, potentially means that banks, lending money, regulators will have their eye on tightening up financial conditions, lending, and that all means that the economic activity will eventually be crimped, will eventually slow because of that crisis. I don't think we can underestimate that enough, even though markets have moved away from that on a technical basis, at least anyway. Aside from that, yes, we've had that OPEC plus cut. Quite a surprise from the cartel, an announcement of more than 1 million barrels per day output cuts only just a few days after delegates had actually signaled no intentions to change production limits. Saudi, they pledged 500,000 barrels per day output cut. Russia will extend the output cuts until year end. We saw oil futures move up around 6% on the day, I think, and they're sort of holding around there now. Interesting that they've, as I say, they fueled inflation bets, and potentially that will be a problem. But at the moment, it's about growth concerns. I think just looking at central banks, it's interesting, two sides developing really. You've got some central banks like the ECB, Bank of England as well, have managed to sort of reliably convey a sort of hawkish message despite that recent market turmoil, while on the other side we've got the Fed, which has had pretty much ultra volatile market pricing for their rate path, which is sort of allied to quite a distinct lack of communication from or a clear message, if you like, from some of the main big hitters at the Fed. I think it's interesting that Fed funds futures now, that curve is currently pricing in a 60% implied probability of no move and around 80 basis points of cuts by year end in the US. We'll briefly look actually at, if I just show you the CME Fed Watch tool, which is what we use a lot, and hopefully you guys use it as well. But this shows the Fed funds futures markets and what they imply for each Fed meeting, if you haven't looked at this before. So we've got the next meetings on the 3rd of May, one after that, 14th of June, you can see me here, then late July, and not one until then late September. So that'll be an interesting period around the summer before we get the back end November and then mid-December. But at the moment, the next meeting, 3rd of May, you can see 60% chance pretty much of no move at all by the Fed now, 40% chance of a 25 basis point hike. And if we just go down, you can see that even a month ago, we had markets betting that rates would go to 5.25% to 5.5%, 32% chance there. So pretty much a 1 in 3% chance that a month ago rates were going to 5.25%. Now, pretty much 60% chance that we don't move. We stay at 4.75%. And you can see then a month ago, there was 0 chance of that, and that markets were betting on either a 25 or a 50 basis point move. And just before the banking crisis, if you remember, I mean, some economists, some Wall Street analysts talking about sort of rates going to 6%. So you can see the sort of paring back of those Fed rate expectations, and that has certainly impacted on the dollar. In the meantime, as I say, we've also got, in fact, if we go to December, you can see where we are, 4.75% at the moment. You can see markets pretty much nailed on that we have cuts. I think there's, as I said, around 80 basis points of cuts now priced in by year end. That's oscillated between sort of 40 and, well, 0 at one point before the banking crisis, up to 80, back to 40, and now again after this soft data, around 80 basis points of cuts priced in. Just on the oil stuff, back to that actually, if you like, just if that rears its head again, then of course oil sensitive currencies have made gains. So that's sort of the Canadian dollar, of course, the NOK, so that's Norwegian krona, while some of the some of the other currencies, majors like the yen, they are paying the price because they are net energy importers, just remember that. And of course the yen is also having trouble because of that safe haven bid really slowing down now, so we get some selling of the yen, and we just have brought in these couple of charts here, bar charts. You can see over the last few webinars. On the left hand side is 2 weeks ago, right hand side is just a few minutes ago. I took a screenshot. You can see sterling, European currencies, so euro, Swiss, still doing well, just still doing very well against the dollar now. This is year to date, so sterling against the dollar, cable, euro dollar, Swiss dollar. And you can really see this sort of difference now between those, as I say, those central banks, which is giving off the message that more hikes are still to be done. I think sterling is really a standout currency at the moment, having broken 125 in cable. Quite a surprise to many analysts, caught sort of short. And really many analysts writing off sterling, if you think only a couple of months ago. Now the strongest currency, the strongest major year to date against the dollar, and markets now I think pricing in over 50 basis points of rate hikes still by the Bank of England, 25 basis points next month, and then another 25 by September, I think it is now. Money markets, that is, pricing in Bank of England rate hikes. Similarly with the euro as well. Interesting that we've still had hawkish speakers calling for the ECB to continue on its rate hike path. Of course, we had that 50 basis point move amid all that banking turmoil. So really the ECB setting its stall, that it was focused on inflation fighting, on its credibility about fighting that core inflation that we'll look at, which still keeps on rising. Set aside or against, if you like, the turmoil in the banking crisis and the sort of stability around the system, systemic stability, if you like. President Lagarde made note of that, separating that out from price stability and inflation and fighting still high, still sticky, elevated inflation in the Eurozone. On the flip side, of course, we've got sort of Kiwi, Aussie dollar. Obviously, we'll run through those shortly, but those central banks really coming to the top, really pausing, potentially rate cuts coming in quicker than expected, and those currencies suffering, as you can see. Okay, just turning to stocks now, global equities, certainly last week, had a great week. Again, macro data at that time sort of registered close to expectations. And of course, the confidence crisis in banking was and has been abating. It's fascinating really how fast, as I've sort of mentioned, really how fast investors kind of forget or forgive really. Even a couple of Fridays ago, we had rumors around Deutsche Bank restructuring over that weekend. But since then, equities have really been marching higher. And certainly indices in the US lifted by cyclical growth stocks, which react very quickly to falling bond yields and falling interest rates. Also the VIX, so that's Wall Street fear gauge, if you like. That's a volatility measure on S&P 30-day stock options, really on the S&P 500 index. That has moved sharply lower. And in fact, let's just show you that before we go to this chart here of the VIX, which just bear with me 1 second if you don't look at this. Let me just find it here. And you can see here, so this is the VIX, as I said, is sort of nicknamed the Wall Street fear gauge. You can see we popped up above 30 during the banking crisis and very volatile back and forth really with sort of rescues by the US banks, then by the S&P and by the Swiss authorities, but then allied with other failures as well and rumors of, as I've mentioned, about Deutsche. So very choppy whipsaw price action, and that was shown, as you can see, in this sort of VIX volatility index. But then we've fallen back below 20. We're now, well, just below 19.74, you can see there, but sort of touching 18 really last week. The long-term average is around 20. If we just pull it back to the monthly, you can see, if I just stick on this dotted line here, is around 20, and then you just see these spikes of volatility that we've seen over the previous decade or so. The pandemic spike, of course, and then we've had the Euro debt crisis spike, and obviously GFC as well in 08. Yeah, that's the volatility index. Just before we go there, let's just go back to that bar chart I was showing you. And you can see here, yeah, so growth stocks really reacting to that big drop in treasury yields, big drop in interest rates, big drop in Fed rate hike expectations, essentially. And really, yeah, at the moment, the NASDAQ has been in the headlines. It closed out its best quarter since 2020, buoyed really by those big bets on big tech, mega cap tech companies who investors really are joyful in a way that higher interest rates have been pulled back, and these big tech companies are obviously solid balance sheets, cash generative. The tech heavy index, that's the NASDAQ then, that gained nearly 17% in the first 3 months of this year. That marked the strongest quarter for the NASDAQ since the second quarter of 2020, actually, when tech stocks obviously led the sharp rebound from the plunge at the start of the pandemic. Even the broader S&P 500, you can just see, sorry, on this chart, then one of the best quarters, obviously, going back to March 2020 or so, 16.8%, I think, up on the first quarter this year. Even the broader S&P 500, that was lifted by strength in tech as well. So their quarterly increase around 7% this year to date. So interesting stuff. The move obviously capped what had been a volatile start to the year with a strong January, then followed by a weak February, and then obviously this rebound over the past few weeks. Much, of course, depends on, as I've said, rate hike expectations really, and what the Fed will do going forward, which we just talked about. If we just look now at some of the technicals, just bear with me 1 sec. Always like to look at the S&P, the Dow, and the NASDAQ, of course. If I just show you the monthly chart here, first of all. So this is the S&P 500. Of course, you can see that long-term downward trend line. So that has acted as resistance. You can see 3 points there, 4 points. We broke above it, then sort of oscillated around it just below 4,000. So really key sort of trend line resistance / support now, it looks like. And we're just trading now above that critical 4,000 level. You've got the 200-day moving average here, which is this black line here, which we touched back in October. That comes below now, quite below, a couple of 100 points below 4,000 now, 3,749. And then at the top here, I've got the 100-day moving average. That's at 4,203, just above 4,200. So this push above, sort of 3 weeks of decent gains, really. You can see this is the weekly chart. And now potentially getting up to that 100-day moving average around 4,200. The high from January, the year-to-date high is at 4,195. So bulls potentially looking to that. Obviously, we've got a lot of major risk events in the pipeline, especially with the non-farm payroll on Friday, then the US CPI next Tuesday as well. So just bear in mind those. But at the moment, some decent momentum. Bulls looking towards 4,200, we think, on the S&P 500. Just on the NASDAQ 100, similarly, you can see this big move from the sort of mid-October lows below 11,000, now above 13,000, a couple of thousand points. And we've also pushed above that, interestingly, that January high. So this year's high, we've pushed above that now. Which is at 12,880 on the NASDAQ 100 this is, so that should act as some support. And then the 100-day moving average is just in line, with, interestingly, with that mid-August top. That mid-August top of 13,720, and then the 100-day moving average just below that of 13,464. You can see that lovely breakout there above the year-to-date high. Actually, sorry, it wasn't the year-to-date high, but very close to. We had the year-to-date high sort of back end of March, actually, at 12,943. We pushed above that. As long as we stay above those sort of levels, 12,900, then potentially this is just bullish consolidation before we push on. The Dow, which is, where are we? Here. Again, lagging slightly. The Dow is chock full of value-based companies, so slightly different than growth companies. But still likes lower interest rates, but sort of not governed as much by their earnings, aren't as much by higher interest rates. But we've had a nice push off this sort of consolidation, this sort of sideways trading in sort of most of March. We pushed up now through the 100-day moving average and just around, you can see the March high at 33,572. So may get some resistance here before then we're back into this sort of very, very strong resistance. We have it going back to August last year. We've kept it in there over the last few months because it's capped. You can see upside there on a number of occasions, even though we got above it there in December, November, end of November, then we couldn't stay above it, couldn't close above it. And especially in January and February this year, struggled, and then fell. And the more you track sideways, then the bigger the breakdown or break up. Break to the upside will be on this occasion. Really too much consolidation, and the sellers won in the end, and we move lower. So yeah, that's at 34,281 on the Dow. Interesting to see whether we can approach that again, with the RSI really not overboard at all at the moment, just around 59 on the daily RSI. Okay, that's enough equities. Let's now look at last week's main events, which very briefly were the Eurozone inflation data. That declined significantly in the headline to 6.9% year on year in March from 8.5% in February. So that's that orange line there. You can see the fall below 7%. The March decline, really, that was widely expected in the headline, all down to energy price developments. So really important to think about that. Headline inflation always affected by energy. Those spiked in March last year. So that base effect, that effect from March last year to now is really pronounced because of the massive spike in March. I think energy inflation in the Eurozone actually fell 13.7% to from 13.7% to negative 0.9% in March. So that really shows you the decline in energy prices, and that's actually the first decline in energy inflation since February 2021. So that's the big base effect affecting the headline. Widely known, widely expected that this would fall. And then we look at other elements, say food. That's one of the biggest contributors to headline inflation in recent months. That has actually increased 15% to 15.4%, and that really indicates price pressures remain quite high in other elements, and that's really shown up and highlighted really by core inflation. You can see that's the darker line here. That increased just a tick to, from 5.6% to 5.7% in March. Services inflation also increasing from 4.8 to 5%. And even though goods inflation fell back slightly, the core reading, this is what the ECB policymakers are focused on. In a way, you should be ignoring this big drop in headline because of these base effects in energy, but core, which strips out energy and food costs, those volatile elements, is clearly too high for policymakers, and that is why they're still hawkish. We also had other data out of the Eurozone, actually PMI data and IFO data, so that's a German business sentiment survey. They showed decent improvements in businesses' assessments of both their current situation and in the near future, and that was across industries, but especially in services. So as I said, ECB expectations for rate hikes, 125 basis point in May, and then another in March especially, and then really it depends on one in May, one in June, that's what's expected, plus a bit more even. So it really depends on this core inflation outlook, especially after the sort of banking turmoil has subsided. If we just look at Eurodollar, obviously, I think generally called the world's most popular currency pair, you can see, yeah, the move from March, sort of off that big move during the banking turmoil, tested though the sort of lows back from February around 105.37, went below there but didn't close on a daily basis, you can see, and then since the bank rescue of Credit Suisse, and really ECB hawks still banging the drum about more work to be done with ECB rate hikes, it's really given a decent bid to the euro, especially against the dollar, which, as we just said, the Fed is looking potentially to pause, and we're now touching that key level. 110.32 is the year-to-date high. We're at 109.50 at the moment. I've also drawn in here a fib level, which if you go to the weekly, you can see that's of the 2021 decline. So that big decline through 2021 and 2022 down to September. So the halfway point of that move is at 109.42. So we're just trading above that slightly. That light grey line is the 100-week moving average at 109.59. So a couple of lines of resistance here potentially before then we can approach that January high at 110.32, as I say, and then above there, if we do push higher, then we've got, say, the 200-week moving average at 112 potentially. That's in Eurodollar. We kind of think, yeah, data will have to really, that non-farm payroll will have to go below 200,000, which we'll look at shortly. But other data really is pointing to weakness in the US. Just briefly, let's touch on the core PCE data that was out of the US on Friday as well, same day as Eurozone data. And here you can just see the chart. And again, this is the Fed's, everybody says it's the Fed's favored inflation gauge. So it's a measure of inflation that the Fed takes as a benchmark. The data takes a month to compile. So it is backward looking and tends not to move the market as much as other yardsticks of prices. So the consumer price index, but The core PCE data, that takes in a wider spectrum of businesses as well as households, so gives a broader picture, if you like, for the Fed. It doesn't show really any significant deceleration, and instead sort of backs up the picture from the CPI data. Inflation in services, not goods, is now the chief problem, and core inflation measured this way, excluding food and energy, edged down very slightly, but really not in the kind of way that might allow the Fed to reverse course. Of course, that's on the inflation side, but then we've had that other data that we'll look at very soon. But just on this chart, you can see how goods inflation, as we said, is falling, the light blue line there, whereas services in the white is still sticky and moving higher. So something to bear in mind as we look at all this other data, which is turning grimmer, if you like, more grim, and then potentially might bring down some of these inflation gauges. This week, then, we've had various bits of data. Before we go to that, in fact, yeah, let's talk about this week's data actually before we go to non-farm. We had that ISM manufacturing data that disappointed on Monday. Instead of the stabilization around 47.7, the ISM dropped to 46.3, so that was its weakest reading since May 2020. It really highlights the sort of global divergence between the loss of momentum in manufacturing and then the sort of better businesses side of things in services activity. Details show really quite broad-based fatigue, if you like, in manufacturing. Production ticked up marginally, but new orders and new export orders fell, and that really doesn't bode well. Employment actually fell deeper below the 50 sort of boom bust mark as well. And it kind of seems companies don't want to commit themselves really to too much given receding demand. We then also get, as I said, services ISM data. That's today, out in a couple of hours in the US. That's expected to moderate to 54.6 in March from 55.1 in February. Really be interesting then whether that folds as well. It's still above that boom bust level, as we say, above 50, but potentially if services then starts to tick lower, then that is coincides with obviously manufacturing as well, already having moved quite sharply down as well. If we just look at the dollar index, just before we go to the dollar index, we'll look at non-farm payroll now. So we've got a nice graphic, hopefully, with all the major numbers that we think are important for the jobs report, which is out on Friday. Of course, that's the monthly non-farm payroll report. So we've got the key numbers here, as I say. So consensus looks for 240,000 in the headline number. And unemployment rate, or 240 actually compares with 311 from last time out, but that beat the consensus. And I think will be lower, let's not forget, will be lower than the 3-month average, around 350K. I think the 6-month average, 336K, 12-month average for non-farm headline, this is 362. The 12-month average. So certainly coming down from that, but still 240,000 jobs created every month is a big number. We can't forget that. Unemployment as well, still seen low, 0.2 higher than the previous number of 3.4%. But again, don't forget 3.4%, a multi-decade low in the jobless rate. And then we get the all-important average earnings, so that's wage growth. They're set to come in at analyst estimates 0.3%, so quite benign still, but a touch quicker than that, I think the 0.2% in February. But that might drag down the annual rate to 4.3 from 4.6%. It's worth noting that the data covers the prior period to the recent regional bank crisis. So that's important to note. Of course, as well, should highlight it is Good Friday, so most markets are closed. So any markets open will have much thinner liquidity, something to bear in mind. on non-farm payroll day, which is always quite volatile anyway. Interestingly, other employment data have improved. So global PMI data, services sector employment data, that's improved in the month, but pared back slightly in the manufacturing sector. We also get, of course, weekly jobless claims data on the Thursday in the US. That coincides with the establishment survey window, actually, and that declined, remains below 200,000 in those weekly initial jobless claims numbers, and kind of highlights that ongoing tightness in the labour market. Other jobs data, actually, this week even, we've had that job opening survey data in the US, which has kind of gained more prominence, of course, as we've become more data dependent, and as well looking at the employment side in the US, which is obviously a major factor for the Fed, being data dependent and then potentially on wage growth. Well, those job openings, they fell 630,000, I think, from the estimate. That was outside the range of the biggest analyst expectations, and actually the lowest print since May 2021. So big fall in job vacancies, if you like, in the US, and that really moved the market lower as well in rate expectations anyway. I think one thing to bear in mind here is that some economists, they've cited the fact that there are still 1.67 jobs available for each unemployed person in the US. And that ratio was 1.2 before the pandemic, when the US labour market was in a strong position. So just something to bear in mind there. Still a lot of job vacancies out there. Kind of means the market is still fairly tight potentially. Okay, that's NFP. You can see I put that 60-40 actually. So what I showed you earlier around the pricing for no change and 25 basis point hike. Okay, I think next we'll just look at the two central bank meetings from this week. We had the Aussie dollar and also the RBA, as well as the RBNZ meeting. Firstly, the RBA, sorry, that was on Tuesday. I've got the Aussie dollar chart here, but the RBA, they kept its policy rate unchanged at 3.6%. That was kind of expected by markets, about an 85% chance, I think, of that happening, 15% chance of a 25 basis point cut. But in fact, there was a Reuters poll which had analysts sort of evenly split between a pause and a hike. But the bank, they pretty much indicated that policy tightening comes with a lag, and that the full effect of their increases in the policy rate still had to be felt. They assume, the bank, that inflation has peaked. Actually, goods prices probably will continue to ease, but rents are still increasing at the fastest pace in some years. The RBA predicts inflation to ease back to 3%, but not till 2025. It also expects growth to be below trend in the next couple of years. But the labour market remains tight. The RBA continues to keep a close eye on labour costs and wages, and it didn't close the door on possible further tightening of policy, which might still be needed. And I think Governor Lowe overnight, actually last night, said pretty much the same thing. 2-year yields, so bond yields, Australian government bond yields, they were lower, obviously, after the RBA announcements. And we've seen the Aussie dollar sort of move lower as well. You can see there on Tuesday, we tapped then, this is the Aussie dollar, we tapped that light grey line, which is the 100-day moving average. Didn't quite get there, 67.98 that is. So that's a sort of pretty firm level of resistance now. I've got in here a fib level of the October rally, and the 38.2 comes at 67.80. So sort of decent resistance there now, it would seem. We've fallen back to a level, pivot level I've got going back here, whether that's still valid or not, but that's levels at 66.81. I'll just take that out actually. Then the next fib level is the halfway point of this October rally at 66.63. So that may offer some support, which it has done previously. Otherwise, potentially we're moving down back towards sort of 66 or so, with that very important cycle year-to-date low from March at 65.63. So that's in the Aussie. Much will do, well, has a lot to do obviously with the RBA, but then obviously global risk sentiment as well. Otherwise, the RBNZ, they really surprised actually overnight last night, raised its policy rate by 50 basis points to 4.75%. Sorry, from 4.75 to 5.25. Markets really expected only a 25 basis point hike, so quite a surprise. It was their 11th consecutive rate hike since the start of their hiking cycle in October of 2021. And the bank really, they kept its analysis that such a rate hike is needed to return inflation back to its 1 to 3% target range. Inflation really is still too high, still too persistent, while employment is beyond its maximum sustainable level. Markets then, they sort of, just to cut to the chase really, markets after that, they still see a 50% plus chance of another hike in the summer. That was the RBNZ's actually own base scenario back in February. And you can see, interestingly, that the Kiwi had jumped nearly, well, around 1% up to 67.79, but now it's given back pretty much all those gains. I think basically markets taking the view that well, that 50% plus chance of a final hike, that was initially after the decision, but now really markets focusing on potentially rate cuts going forward. And I'm just trying to look at what is priced in. We're now at 5.25%. I'm just checking prices. I can't really see when the next hike is now. It was projected another hike, as I say, quarter basis points, 25 basis points, so up to 5.5% projected peak rate. But rate cuts are now priced in by the end of the year. Markets probably focusing on that, and you can see Kiwi giving up all those gains. This line here, 100-day moving average, capped the upside before. You can see in March. That's at 62.97, so potentially support, maybe resistance if we fall back below there, and that candle does look ominous, doesn't it? If we close around these levels, then I would say we move back into this range with that January high around 61.91 sort of being decent support potentially. That's in Kiwi dollar. Okay, no questions, which is probably not sure a good thing or a bad thing. I'll wrap it up there, but hopefully that's been useful to you guys. If you do, as I say, have any questions, do ask them next time in the webinar. We are back in 2 weeks' time, and hopefully we will speak to you then. Okay, good luck and take care.